I feel like we're like in one of those moments, and we've had them off and on over the years. It reminds me a lot of like that risk on, risk off kind of market environment that we had previously spent months in during different years throughout the recovery. 2011 stands out. I think we probably did this in 2015 too, where you have these days where it's just obvious today's a risk on day, and so they sell off all the bond proxy stocks, they sell off all the defensive sectors, and the high beta stuff goes nuts. And then maybe it lasts for a day or 2 days, and then all of a sudden you find yourself on one of those other days where they're taking up consumer staple stocks and REITs and utilities, and everything else gets dumped. I don't know that we're definitively in that for a long time, but we've definitely been in that for the last week or so. And maybe that's the way it has to be until we get to that next Fed meeting in September. It's my best guess. One thing I think is interesting, and we called this out the other day, ITB right near a new 52-week high. There are very few industry groups that can say that they're doing that right now outside of defensive stocks. So these are home construction. These are obviously companies that benefit from lower borrowing rates. What these stocks are telling you is that lower rates are probably a permanent feature of the landscape for the next year or so. That could end up being wrong, but that is what they seem to be pricing in. And there were some really, really cheap names in this group that thought the housing rally was over. Perhaps not.
Anastasia, do we need to have a conversation on which market's right, the bond market or the equity market?
Yeah, look, this has been an ongoing conversation, but I honestly don't know that either one of them is wrong or one of them is right. I think what the markets are pricing in is the backdrop of growth that is sluggish, but also policymakers are going to be increasingly active here. I mean, if you think about the G10 global 10-year yield, it's about 0.6%, and potentially could be headed lower if you have additional tide of central bank easing, which we do expect. So this is not necessarily so strange. The yields are where they are. Now, I will say the yields are pricing in growth rates that are pretty subpar and probably below what our forecasts are. Now, stocks, on the other hand, are saying, look, at some point there's a Trump put, there is a Fed put, there's a ECB put, and so on, and that's what the stocks are trading on.
If you think that still exists, as Anastasia says, Mike Wilson throws cold water on all of that, says there's no such thing anymore as a Trump put, Fed put. They've all, in his word, expired. Is he right?
I think that's true, with the exception of today came out and called for a 100 basis point cut.
The president
in the Fed fund. The president did. If that happens, there's a pretty big Fed put under the market. But absent that, the market's already priced in continued easing. I don't know what Trump can do other than jawbone it. Because we're out of fiscal policy in terms of the ability of Congress to do anything. Definitely not in front of the elections.
Fed can jawbone it, though, this week.
The
right?
Fed can,
in Jackson Hole.
But you've got an issue with the credibility of Powell. So you don't know which way he's going to do. He's changed his mind a few times. I don't think the market's putting a lot of stock in. As a matter of fact, I think the market is leading the dialogue, not the Fed. I don't really see that changing. So I believe you have two choices in this market. You can stand pat the way you are, come back in a year, 2 years, don't even look at it because the volatility is going to continue. Or you can try and be opportunistic, both selling these major pops and buying the major highly emotional lows. That's where you've got to be.